Right, everybody, glad to have you here. Let's start off with some standard disclaimers. So, you understand crypto is volatile and contains financial risk. Portfolio allocation matters. Don't invest more than you're willing to lose or need money for in the short term. Always think for yourself, do your own research. I may be a well-spoken idiot. Also, don't believe what other people tell you. Always think critically, and I welcome counter arguments to anything I present. I am not a financial advisor and definitely not your financial advisor, and this is for your education. This is focused on fundamentals of a disruptive technology versus how to trade price action, because if you want to trade for quick gains, you don't really need crypto for that. You agree not to hold me responsible for any financial loss, but I will welcome a coffee for any financial gain. You agree to be recorded for the benefit of those who can't attend. If you want to speak more personally, I am happy to connect with you outside of these group calls. Right, let's proceed. My personal journey, as some of you know, I discovered Bitcoin relatively early on. I bought my first Bitcoin around $20 in 2012. I saw it 50x to a first cycle peak of $1,000, then crashed to $200. I sold most of it around $250 for what I thought was a 12x gain and thought that was good. My lesson learned was understand why I'm buying, what I'm buying, and buy to hold for the long term. In 2014, as you know, I'm in Solar, which shares parallels with Bitcoin for decentralization. Solar decentralizes energy and Bitcoin decentralizes money. During this cycle peak, a customer purchased a solar system paid entirely in Bitcoin. We converted most of it to cash out to pay cost of goods and thought the real world use case was interesting. In 2017, I completed the Princeton course on Bitcoin and cryptocurrencies and came to understand the fundamentals of blockchain. During this year, it was the ICO hype cycle of 2017. I divested some BTC into alts, most of which are zero today. So my lesson learned from this cycle was that most alts are highly speculative and prone to failure despite using blockchain technology. So after holding through the crypto winter, I feel a moral imperative to share what I've learned from prior cycles to aid friends in their decision-making and perhaps broaden their perspective on crypto. So let's start with the question, what is money? This is a subject that needs to be taught in school, or at least from parents to their children. It is like the background hum of our life. However, we just blindly accept its existence. Money is the apex form of energy that allows exchange into all other forms of energy, such as property or services. And money is the most globally accepted narrative. Yuval Noah Harris writes on the power of narrative in his book Sapiens that led humans to becoming the dominant species on Earth. The Greek polymath Aristotle found that money, as a common measure of everything, allows us to compare value between goods and services. He offered several characteristics for good money that are the foundation for what economists utilize today. Deeper definitions are at the St. Louis Fed website listed here. Over time, humans have always evolved from bad money to good money. For example, cows are bad money because they don't hold these characteristics as well as gold or USD does. This is known as Thayer's law, which states that good money will drive out bad money. Bitcoin is arguably gooder money because it holds more of the characteristics of good money. The value, the purchasing power of the US dollar has fallen over time as money supply has grown. In fact, a dollar in 1913 had the same purchasing power as $26 in 2020. In 1913, the Federal Reserve Act granted Federal Reserve banks the ability to manage the money supply in order to ensure economic stability. Back then, $1 could buy 30 Hershey's chocolate bars. By the late 1960s, the number of dollars in circulation was too high to be backed by US gold reserves. President Nixon ceased direct convertibility of US dollars to gold in 1971. This ended both the gold standard and the limit on the amount of currency that could be printed. The value of the US dollar is being eroded over time, which means nobody holding cash is having that cash, which means anybody holding cash is having that cash lose value. And it is losing much more than the average 2% per year consumer price index, which was actually 5.4% in July, which people commonly think of as inflation. Does this chart seem abnormal to anyone? Everybody's US dollars got diluted by 20% in 1 year. The extra cash is flowing to assets and real estate, and that's where inflation is happening. Most people saw their assets increase in value last year, but if you account for the 20% plus monetary expansion in 1 year, the true gains in assets are more modest, if any at all. Now, I am nonpartisan. I'm not even a citizen of the US. So to me, it's less about left or right, but rather fundamentals of governance and monetary policy. Throughout history, whenever trust gets too low, it leads to revolution. Will that happen in the US? I'm not sure, and I hope not. But one of the reasons for low trust ratings is that the government does not know how to manage money. The US debt clock is a grave reminder that despite Washington's attempts to balance the budget, the federal debt keeps soaring. At present, the debt stands over $29 trillion, which is equivalent to $228,000 per taxpayer. The debt to GDP ratio is now 125%, which means we owe more than we produce. If things keep trending this way, it is clearly unsustainable. We are at the first stage of hyperinflation, where a government is printing money to pay for its spending. The second stage is if the Fed does not tighten the money supply by raising interest rates, but instead keeps printing more money. Keep an eye out to see if this happens. The third stage occurs if goods and services rise more than 50% in a month. Keep an eye out for this. That being said, I certainly hope we are too smart in the US to hyperinflate our own economy. There are several countries in the world right now undergoing hyperinflation, marked in red. In the past, we also had Germany, Argentina, Mexico, and Zimbabwe go through periods of hyperinflation. All of these countries are in need of a monetary system that cannot be hyperinflated away. Bitcoin is a potential solution for them. So having an understanding of money, we can now start to understand Bitcoin and its use cases. Any questions up to this point? All right, let's dive in. What is Bitcoin? Peter Diamandis, founder and chairman of the X Prize Foundation, co-founder and executive chairman of Singularity University, says, at its core, Bitcoin is a smart currency designed by very forward-thinking engineers. It eliminates the need for banks, gets rid of credit card fees, currency exchange fees, money transfer fees, and reduces the need for lawyers and transitions. All good things. I'd like to offer another perspective. Bitcoin is time. When we exchange dollars with each other, we are exchanging representations of hours of our lives that we exchanged for those dollars. If the value of those dollars are inflated away without earnings rising commensurately, which is currently the case, it is a surreptitious theft on the very substance that makes up our lives, time. Now, if you read the Bitcoin white paper, 3 out of the 8 references in the white paper are for timestamping. Bitcoin is fundamentally a method of distributed digital timestamping. If you think about all the inventions of the modern era, the modern clock is one of the most powerful tools and a key factor of the industrial age. Bitcoin's technology evolves the clock and would provide a method of interplanetary timekeeping if we ever get to that stage. I highly encourage reading the article titled Bitcoin's Time, that is linked here. It is one of the most beautiful philosophical treatises on Bitcoin I've ever read. So what is the value of decentralized digital timekeeping? It allows us to solve one of the holy grails of computer science, the double spend problem. Prior to blockchain, digital items could be copied, which is why we've never had digital internet money until now. The copying of digital items has led to all kinds of copyright issues with music, movies, images, data, and so on. Bitcoin solves the double spend problem that has eluded computer scientists for decades, allowing us to mathematically prove there is one and only one owner of a digital item, which allows the creation of internet money. Beyond this, the ability to create unique digital items opens up a whole new realm of possibility, which NFTs and other blockchain technologies are exploring. All valuable things are becoming digitized. So with books, libraries have become Google. With music, CDs have become Spotify. With movies, DVDs have become Netflix. Maps, Tom's Guide has become Waze. And so it follows that money will also be digitized. We just didn't have the ability to do it until now. So if somebody says Bitcoin has no intrinsic value, they don't understand this breakthrough. Some other key facts about Bitcoin. Bitcoin was created by a person or people named Satoshi Nakamoto by posting a white paper on a cryptographic forum. Nobody knows who Satoshi Nakamoto is, and nobody has heard from him since 2011. Some people claim to be him, but nobody has verified it by moving one of the original Bitcoin from the very first Bitcoin mined in the Genesis block. The current market cap of Bitcoin is about $850 billion, and it touched $1 trillion at its peak. Other cryptocurrencies try to improve on Bitcoin's technology or offer alternative applications of the double spend problem beyond money. So far, no other cryptocurrency has exceeded the market cap of Bitcoin in the past 12 years, but Ethereum has come close to flipping Bitcoin. One of the most unique aspects of Bitcoin that gives its good money value of scarcity is the fixed supply of 21 million Bitcoin. The 21 millionth Bitcoin will be mined in about 120 years, with the supply halving approximately every 4 years, which creates an asymptotic log function of supply. Currently, 18.8 million Bitcoin have been mined out of the total 21 million, and several million are known to be lost. An analogy for Bitcoin. Imagine if keeping your car idling 24/7 produced solved Sudoku puzzles that you could trade for drugs on the dark web. Now, of course, Bitcoin is much more than that, and I won't go into the hashing functions of Bitcoin since it gets much more technical than most people need to know, but happy to discuss that further outside of this presentation. At a high level, the Bitcoin network is made up of miners and nodes. Anybody with an internet connection can run software to be either a miner or a node. Miners solve math problems, kind of like solving Sudokus, to earn Bitcoin and validate transactions. And nodes maintain the history of the entire Bitcoin ledger and have voting rights for the Bitcoin software. So in order to hack the Bitcoin network, somebody would need to take over 51% of the network computing power, which there are inherent bottlenecks to doing so via hardware and energy supply. As a reference, the computing power in Bitcoin is more than 100 times that of Google. So you would need more than all of Google's computing power pointing directly at Bitcoin in order to hack it. Game theory also incentivizes everybody to be good actors because everybody involved in Bitcoin wants to protect the network so the value of Bitcoin goes up. So it wouldn't make economic sense to spend billions in energy to steal Bitcoin because then that would devalue what they just stole. Bitcoin is also anti-fragile, meaning every time it survives an attack, it becomes stronger, and it is subject to the Lindy effect, which means for every year it survives, it is more likely to keep surviving. With no CEO and no central organization, it is impossible to sue or stop Bitcoin. The Bitcoin network is global, 24/7, and dynamically reorganizes on a minute-by-minute basis with a new block added to the blockchain every 10 minutes, no matter how many or how few miners there are. Currently, it costs about $8,000 to generate 1 Bitcoin by a miner. So if the price of Bitcoin falls below that, then it becomes unprofitable for most miners to mine Bitcoin. The size of the Bitcoin blockchain is about 360 gigabytes. So if you have the hard drive space and you want to participate in the network, you can. Are there any specific questions on how Bitcoin works?
Yes, Ko had a question. Let me just let Ellen in. Ko says, what do you think about the amount of aggregate energy needed for Bitcoin mining and the criticisms about impact to the environment?
Excellent question. I have a section later in this presentation that actually breaks down all the energy statistics of Bitcoin. So I'll get to that later, Kwon. Right. Please mute if you are watching. So
yeah, I got it.
There is a term called FUD, which stands for fear, uncertainty, and doubt. And you've probably seen a lot of these headlines in the news. You'd be crazy to spend Bitcoin. Bitcoin's headed to zero. Warren Buffett says Bitcoin is rat poison squared. And Bitcoin has died many times. There's a website called Bitcoin Obituaries, which tracks all the times that Bitcoin has died, which is around 428 times now, which with its most recent death, end of August, that cryptocurrencies will eventually prove to be worthless. And you may have heard the narrative, no one uses Bitcoin. So in 2010, people were like, Bitcoin, WTF, what's that? 2012, only nerds use Bitcoin. 2013 to 2015, only drug dealers, money launderers use Bitcoin. 2017, only speculators use Bitcoin. 2019, less than 1% of the population use Bitcoin. 2020, only small companies use Bitcoin. 2021, only small countries like El Salvador use Bitcoin. And in case you haven't heard the recent news, Ukraine also just adopted Bitcoin as a legal tender. So as you can see, the narrative is changing over time. In its formative years, Bitcoin was dismissed by institutions as a shadowy, worthless digital asset favored by criminals. Gradually, sentiment has shifted, and Bitcoin now bears the hallmark of institutional acceptance. When BlackRock adds crypto to its balance sheet, financial advisors and high net worth individuals naturally pay attention. BlackRock is the world's largest asset manager with $9.5 trillion under management and is one of 16 mutual fund managers, including Morgan Stanley, to gain exposure to the crypto market. A recent study conducted by Fidelity found that 7 in 10 institutional investors expect to buy or invest in crypto assets in the near future. A separate survey by Nickel Digital Asset Management came to a similar conclusion with 82% of respondents expecting to increase their crypto allocation in the next 2 years. Just over a third of the respondents said the involvement of more leading corporates and fund managers has given them greater confidence to invest. So we are at a unique time in history to front run the institutions. As you can see, the narrative has changed even within institutions like JP Morgan. 2015, Jamie Dimon said, virtual currency will be stopped. Then he said, in 2017, Bitcoin is a fraud that will eventually blow up. Fast forward to 2021, JP Morgan may offer actively managed Bitcoin fund. Other signs of the times. Second largest US mortgage lender will accept payment in Bitcoin. Ray Dalio, who runs one of the world's largest hedge funds, his CFO from Bridgewater left to work on Bitcoin full-time. Several countries all over the world, as you can see from this global crypto adoption index, are adopting Bitcoin and crypto. Just a few years ago, 0 public companies held Bitcoin on their balance sheet. Today, we have 64 public companies reporting Bitcoin holdings. Michael Saylor, CEO of MicroStrategy, was the first publicly listed company to spend millions in legal fees to put Bitcoin on his corporate balance sheet. He has since open sourced all the legal documents for that so that other corporations can follow suit. And that's just public companies. We also have private companies, family offices, ETFs, and governments holding Bitcoin. Although El Salvador and Ukraine are the 2 recent countries to make Bitcoin legal tender, the government of Bulgaria holds a sizable amount of Bitcoin on its balance sheet. We also have senators, both Democrat and Republican, lobbying in favor of Bitcoin. Cynthia Loomis is a Republican senator from Wyoming, and she's working to get legislation passed that would establish a digital asset working group with federal regulators, including representatives from the SEC and CFTC. She envisions more regulatory framework in the next 3 or 4 years, paving the way for more institutions to use Bitcoin as a legal tender. She's long on Bitcoin. The adoption for crypto is closely following the internet. The timing is similar to 1997 of AOL and going online on the World Wide Web. Back when we had dial-up modems, when most people didn't trust it, didn't understand it, and it was a clunky user interface, very much like crypto today. Deutsche Bank forecasts continued adoption as per network effects. Every mainstream technology has an adoption curve. Bitcoin currently has less than 5% market penetration. Due to the connectivity of the internet, growth is accelerating. Microsoft took 44 years to hit $1 trillion market cap. Google took 21 years, and Bitcoin took 12 years. Are there any questions about the adoption of Bitcoin?
Yeah, it has. We got some great questions here. So CK asks, what's the core reason why this narrative is changing? I believe he's referring to the JP Morgan slides of how he went from, oh, this is a fraud, and then now more and more adoption.
I think from what I'm seeing, the key narrative is because of the hyperinflation trends or hallmarks which are happening. So 2020, when COVID happened, was a key year that created a perfect macro environment for disruptive technologies and Bitcoin. When the market crashed, the Fed came out and said, we will do whatever it takes and print as much money as we need to keep the market afloat. Anybody who understands money and monetary theory and economics sees that there's significant devaluation and debasement of our currency happening. And as a result, Bitcoin is a hedge against hyperinflation or simply erosion of value. One other aspect is that Bitcoin just holds stronger monetary properties against all other asset classes.
Exactly. All right. And yeah, has showed this on a slide earlier, that over 20% of the total money supply was printed last year. That's 1/5 of all money supply ever printed. So that's why you'll see
in existence.
of the US dollars in existence. So that's why a lot of people, Michael Saylor, a lot of these hedge fund people who understand money is realizing that the money that we're holding is becoming less valuable the more money that's printed. So great question, CK. And then Henna brings up, what are the most efficient ways to mine Bitcoin? Re-engineering gaming cards, etc. What is the setup like?
Yeah, so the mining of Bitcoin started with just using CPUs. And then it went to graphic cards and gaming cards. Now, there are manufacturers producing what's called ASICs, or application-specific integrated circuits, meaning cards and hardware specifically geared to mine Bitcoin, or the SHA-256 hashing algorithm. So that is currently the most efficient way, and it's in continual development. So they're optimizing the hardware, not only to solve the math problem that Bitcoin posits, but also to do it in an energy efficient manner.
Yep, they're utilizing energy. Let's say in Iceland, geothermal energy. El Salvador is using the power of the volcanoes. And so utilizing different energies to solve these mathematical equations. Great question, Hannah. All right, Stefan, do you see the value of Bitcoin increasing with adoption? Is there a causal relationship?
Yes, there's definitely a causal relationship between adoption and the price of Bitcoin, which is known as Metcalfe's law, which I have some slides dedicated to. So we will get to that on how the number of adoptees affects price.
Nice. David Lopez asks, BTC market penetration of what? What's the market? I'm afraid he's referring to maybe gold.
Yeah, so the $1 trillion is the amount of monetary dollars that have been put into it. And then if he's referring to adoption, it can also be calculated as number of active addresses on the network.
Yep, adoption is definitely a big key. And we'll get into Lightning Network and how that's growing rapidly as well. Okay, Elite says, can the government ban Bitcoin?
So that is one of the beauties of Bitcoin, is because it has no CEO and no central organization and just runs on a peer-to-peer software network. It is pretty much impossible to stop unless you stop the internet. It is similar to trying to ban torrenting. And if you've ever run a torrent or looked at it, it's impossible to stop. So the government can try and slow down adoption by banning exchanges, by banning mining, but it's pretty much impossible to ban the Bitcoin software itself unless you shut down the internet.
Great. All right, CK asks, emotional reasons. Smart money is adapting Bitcoin and momentum is gaining. I don't want to miss out. Oh, I think he was making a comment about.
Yep, the smart money is clearly moving in.
A lot more institutions than the previous cycle in 2017, for sure.
Yeah, in 2017, there were 0 public companies. So, one excellent phrase I've heard from many financial managers is that Bitcoin is a better buy at $35,000 than it was at $10,000. Because for it to reach $35,000, it becomes a size that's almost too big to fail. Now we have public companies listed on NASDAQ, such as Coinbase. We have billions of dollars worth of jobs, people's investments involved. The bigger it gets, the harder it is to shut down.
Could I ask a
Yep.
question?
Yeah, go ahead, CK.
Yeah, I don't really know how to articulate this in a beautiful question way, but the value of a currency becomes more valuable if you spend it and use it. My understanding is that people treat Bitcoin as gold, so they hold on to it, they barely use it. Could you help me reconcile
Yes.
the value and as well as the people's behavior pattern of just trying to hoard it and hold it?
Yeah. So currency goes through different stages before it reaches transactional. So something has to function well as a store of value before it can become a widely transacted currency. If you can't hold it and have it hold value, it's not going to work well as something you frequently transact. So currently, Bitcoin is going through the store of value stage. Once it has clearly proven itself as a store of value, then it will increasingly move towards the daily currency usage stage.
And to disrupt gold, what kind of market cap are we looking at? What gold has and what the opportunity of just disrupting gold as the narrative of being a store of value?
So people commonly use gold as a hedge against inflation as well as a store of value. And the current market cap of gold is about $10 trillion. So Bitcoin holds all the properties of gold, but it's much easier to transport and secure than gold. And so if Bitcoin were to disrupt the market cap of gold, that offers a 10x upside. Even if Bitcoin were to just disrupt half of gold, say the millennial generation and Gen Z decide, instead of buying gold, I want to buy Bitcoin, that offers a potential 5x upside from the current $1 trillion market cap of Bitcoin.
He commented, you lost me at the 10x upside comment.
Sure. Let me try and clarify that. So the current market cap of Bitcoin is $1 trillion. The market cap of gold is $10 trillion. So if all the money and the value were to flow from gold into Bitcoin, that means Bitcoin would become a $10 trillion asset, which is going from $1 trillion to $10 trillion is a 10x.
So if you invest $100,000, you could net $1 million before it going 10x if it disrupts gold, which people call it, a term that they call it is gold 2.0, digital gold.
Digital
2.0.
gold, right. And this is one of the key premises that the Winklevoss twins, the guys who were in the lawsuit against Mark Zuckerberg for Facebook and founders of Gemini, one of the leading cryptocurrency exchanges, the Winklevoss twins strongly believe that Bitcoin will disrupt gold.
Nice. I believe that's all the questions we have for now. Keep them coming. Great questions, everyone.
Right. So if you're to leave with anything today, I'd like you to leave remembering that Bitcoin is the killer app for asset protection and asset transference, both due to its decentralized nature. So these are two really important concepts. I'll say it again. So what is Bitcoin's killer application? Bitcoin is unseizable and it is censorship resistant. Bitcoin is unseizable. Nobody can take it from you against your will. Bank accounts can be frozen, real estate can be foreclosed, equities can be liquidated, and gold can be physically taken. Access to your Bitcoin comes down to a passphrase. which can be stored on an encrypted USB stick or even in your head. There is some value, intrinsic inherent value, in allocating part of your portfolio to an asset that cannot be seized against your will, even if you consider it just as a shit hits the fan insurance. Bitcoin is unseizable considering you secure your passphrase responsibly. Bitcoin is censorship resistant. It allows you to transfer value to anyone, anywhere in the world at any time. There are limits to who, where, and when you can wire money. There are limits and difficulties to transporting gold bars. There are sometimes even limits on transferring your assets at death. Bitcoin allows anyone to transfer value to anyone without any government or third party being able to stop it. Bitcoin's transparency and decentralization guards against corruption and single points of failure. And Bitcoin is impervious to current hacking technology. It is the most secure computer network on planet Earth. There is a $1 trillion bounty of Bitcoin if somebody were able to steal them. Hackers are trying every day and governments have tried to stop it without success. Bitcoin can be leveraged as a store of value asset and offers beneficial tax treatment. So instead of selling Bitcoin and incurring short or long-term capital gains tax, you can borrow against it as an asset, similar to real estate. Now, one very useful property of Bitcoin is that you can also sell Bitcoin for a loss and book the loss to reduce or eliminate capital gains tax on winning investments. Then immediately buy the crypto you sold to capture future gains. Now, this is a little complex, so I'll try and give a scenario. Say you bought Bitcoin at its recent peak of $65,000. You have one Bitcoin is $65,000. Then it crashes to $40,000. You can sell the Bitcoin at $40,000, book a negative $25,000 loss, and then buy that Bitcoin back immediately. So you still end up with one Bitcoin plus a negative $25,000 paper loss that you can write off against your other gains. Are there any questions there?
This is a really big advantage for Bitcoin and crypto. And for those of you guys who are just tuning in, this is not financial advice. It's only for educational purposes. But this is something, a big advantage that is not as well known per se. So in stocks, if you were to do that and use, let's say you do that with Apple, right? You have to wait. There's something called net 30, where you have to wait 30 days before you can do that. Versus Bitcoin, you can, just as Harold said, if it drops, you can sell out of it. And as long as you're a believer, right, in the long term and what it represents, and you buy right back in, then you're able to write off those losses. Yes, CK says, sounds like an awesome hack to reduce taxes.
Yeah. So Bitcoin is the best performing asset over the last 10 years, except for 2014 and 2018, which were correction years as part of a 4-year cycle that it operates on. We are currently partway through Bitcoin's 4th cycle. The Sharpe ratio is a method of calculating risk-adjusted return. Bitcoin outperforms all other assets despite its volatility over a 4-year period. If you bought Bitcoin at any time in the past 12 years and held for 4 years, you would have over 100% return on your investment, even if you bought at the very peak of any cycle. For example, if you bought at the peak of $20,000 in 2017, you would still be up over 100% today. People often compare Bitcoin to a bubble like tulips, the South Sea Company, etc., or even a Ponzi scheme like Madoff. After bubbles pop, they typically don't reflate. Nobody reinvests in a scam like Madoff after his bubble pops. Yes, Bitcoin has volatility, as can be seen from these peaks and troughs. However, every drawdown is higher than the previous low and the floor keeps increasing. This is because the short-term speculators are driven out and an increasing number of people come to understand the technology and hold the asset despite significant drawdowns. There is a clear and definite trend upward, despite interim volatility driven by speculation. It looks like a bubble if you zoom in on one section here, but zoom out to see the larger trend. So I've shared a lot of historical and past data, and we see clear trends from the past, but past performance does not predict future results. So can we model the future value of Bitcoin? To quote George Box, all models are wrong, but some are useful. So in the next few slides, I'll share a few models that can be used across several asset classes, and we'll apply it to Bitcoin. If you find one useful or interesting, you could explore it further. So network effects account for about 70% of the value of digital companies. Network effects were popularized by Robert Metcalfe, one of the co-inventors of the Ethernet and a co-founder of 3Com. Metcalfe explained that while the cost of the network was directly proportional to the number of Ethernet cards, the value of the network was proportional to the square of the number of users. In other words, the value was due to the connectivity between users, enabling them to work together and achieve more than they could alone. If somebody created a superior phone, but nobody uses it, it doesn't have value. If somebody creates a superior gaming system, but all your friends play Xbox, Xbox will have greater value. Facebook, Uber, and Airbnb have value because of the network, not because of their software, which are relatively simple in comparison. With any software that relies on networks, it is not the superior technology that wins out. It is the tech with the greatest network effect. Beware cryptocurrencies that claim to have superior technology. Examine whether they have network effect and if their value reflects Metcalfe's law. Metcalfe's law is a mathematical and scientific fact. You can calculate it and apply it to any network. The Bitcoin mempool is where all the valid transactions wait to be confirmed by the Bitcoin network and is an indicator of active nodes transmitting on the Bitcoin network. We can see that price action closely matches Metcalfe's law applied to Bitcoin's mempool. Another model to consider is log regression analysis. Bitcoin moves in log, not linear format, and moves in 4-year cycles due to the halving process. People often have a narrow focus on the current day or week price action where there are significant drops and don't zoom out to see the longer term view. Every 4 years, approximately, there are half as many new Bitcoins added to the Bitcoin network. So Bitcoin becomes considerably more scarce, which drives the value of each new Bitcoin higher. When miners receive half as many Bitcoins for solving their Sudokus, they have to sell each one for more to cover their real world overhead costs. There have been 3 Bitcoin halving cycles so far, and we are partway through our 4th cycle. It seems that each cycle is lengthening and flattening, which means it takes longer to reach the peak and the volatility is dampening. Another model to consider is stock to flow, which models based on supply and demand. Bitcoin is unique in that supply is perfectly predictable and transparent, which no other asset class has. Gold mining is variable. Stock issuance is variable. even currency issuance is variable. With the perfectly predictable supply of Bitcoin, the only side of the equation to solve for is demand, which we have a clear idea of by examining adoption. So here's a chart using stock to flow analysis to map the price of Bitcoin over time. Another model to consider is energy input into the Bitcoin network. In 1921, Henry Ford predicted there would be a currency based on energy. Ford's argument for energy currency was that, unlike gold, it could not be controlled. Instead, every country could issue currency based on the natural wealth of its energy resources. The very first Bitcoin was priced based off the energy it took to create that Bitcoin. Without energy consumed, used to create Bitcoin and maintain the Bitcoin network, there would be no Bitcoin. It fundamentally needs energy put into it. So here's a comparison of stock to flow versus the energy value of Bitcoin versus the actual price. All three have decent correlation. It is useful to use several models to triangulate truth. I provided links to further in-depth studies of all of these models. Speaking of energy usage, you may have heard FUD, or fear, uncertainty, and doubt around Bitcoin for boiling the Earth's oceans, consuming all of the Earth's energy, and whatnot. Bitcoin uses that tiny green sliver, 189 terawatt hours, which is 0.1% of the world's energy production, and actually uses 0.4% of wasted energy. Bitcoin miners are incentivized to utilize the cheapest form of energy to improve their profits. And wasted energy is the cheapest form because nobody's using it. For example, if a solar farm is producing 2 megawatts of power, but only 1 megawatt is being used, there is 1 megawatt of wasted energy, and the costs of the solar farm have already been incurred. So Bitcoin miners can use this excess energy to mine Bitcoin and maximize their profit. Wasted energy also comes in the form of the flaring of gas, hydro, wind, etc. Bitcoin miners are also able to profit from unmonetized energy. An example of previously unmonetized energy are waterfalls for hydro, volcanoes for geothermal, or deserts for solar. It typically doesn't make economic sense to build the infrastructure to pipe the energy from these remote locations to cities where the energy is actually used. However, Bitcoin miners can monetize these remote locations by powering Bitcoin mining rigs at the location, earning Bitcoin, then transmitting that Bitcoin to anybody, anywhere in the world over the internet. And this is currently happening in El Salvador and will provide that country with a new source of GDP. Bitcoin miners typically use more renewable energy as a percentage of their energy mix compared to most countries, including the US, which generates 30% only of our energy from renewables. And this is because Bitcoin miners are incentivized to use renewable energy since it's one of the cheapest forms of energy. The cheaper the energy, the greater the profit for the Bitcoin miners. Are there any questions on the state of Bitcoin energy? Hopefully that answered your question, Kwa.
Yeah, we got some questions, but not specifically for the energy. So
yeah, can answer any other.
Okay, so one question is, what's the best way to get started buying? There are so many services.
I'll cover that at the end with the resources.
Yep, we definitely have ways for you to get started. And you had a slide on proof of work versus proof of stake. Ellen asks, what are your thoughts on Ethereum? So maybe you can provide an example of how Bitcoin utilizes proof of work and Ethereum is moving towards proof of stake, and your thoughts on Ethereum.
Yeah. So Bitcoin uses energy because of its proof of work protocol, which requires energy to solve math problems that secure the Bitcoin network. As an alternative, there are other cryptocurrencies that utilize a method called proof of stake to secure the network. And many environmentalists prefer proof of stake blockchains because it's not energy intensive. To validate transactions on a proof of stake network, a user just stakes or locks a specific amount of tokens in that network's contract. They then mine, or rather mint, new coins proportional to how many of their own tokens they have and how long they have staked them, which is kind of like a dividend. If a user on a proof of stake network like Ethereum acts maliciously, they may lose their stake as a result of their actions. So that's what incentivizes good actors to secure the network. So there are some concerns with this method. For example, the network is subject to dominance by the most significant token holders. That provides more power to early adopters and people with the most money that they stake on the network. Proof of stake is also not as time-tested and proven to be anti-fragile as proof of work. Ethereum is currently in the process of switching from proof of work to proof of stake, and the world is waiting to see how this will play out over the next year or so. There are many other blockchain security and consensus mechanisms, but these are the two major ones. Does that answer your question, Ellen?
Yeah, feel free to put into the chat, Ellen. So here's a question. What's Bitcoin's best case scenario? Become the most used currency and absorb all former competing currencies' values? Maybe we can talk about hyper Bitcoinization.
So what I see as the best case scenario is that Bitcoin becomes the world reserve currency. I do not believe that Bitcoin will replace all currencies, because I believe every country will want to maintain some control over its own monetary policy. But I can see every country using the Bitcoin rails for their own digital currencies. So for example, if the US dollar goes digital, the US dollar can use the Bitcoin network to transact, as well as use Bitcoin as a reserve currency in the same way that the US dollar used to use gold as a reserve currency.
Great. So a question is the US, and this relates to what we're talking about here. The US government is very powerful. BTC can be seen as a threat. Is there any potential regulation that could serve as a Bitcoin killer?
So currently there's a lot of regulation being worked through. The biggest threat was several years ago in 2016, 17, when the CFTC and SEC were trying to determine what Bitcoin was. Like, is it a security? Is it a commodity? Is it property? And is it just something that's purely illegal? That was the key milestone and turning point. Fortunately, it was ruled that Bitcoin is property. So now that Bitcoin has been classified as property, all that sets precedents, and all future laws are built on top of that. So that would have to be repealed in order to turn things back. And the further we go down the Bitcoin rabbit hole as it gains adoption, that becomes more and more difficult, which actually leads to a great segue to discuss the biggest risks to Bitcoin. So one of the biggest risks to Bitcoin is, ironically, good government policy. people who understand the cracks in our monetary system are acquiring Bitcoin as a hedge. So if governments develop sound monetary policy, the pressing need for Bitcoin as a hedge against inflation would reduce. Another risk, government bans. So the government could ban possession of Bitcoin the same way that the US banned the possession of gold for 40 years, from the mid-1930s to the mid-1970s. Although this is much harder to enforce than gold, because gold, you can obviously see gold bars. It's hard to ban a string of words in your head. Even China, as authoritarian as they are, realized they couldn't do this. So they banned all the fiat on-ramps, which are much easier to track and choke. It would slow adoption, but not stop the peer-to-peer network or break the Bitcoin technology itself. The bigger the market cap of Bitcoin gets, the harder it is to ban, because the donor class will own it, politicians will own it, and of course, we now have public corporations that own it. Banning Bitcoin would destroy hundreds of billions of dollars of wealth for a country's citizens. Next risk, bugs and quantum computing. Since Bitcoin is code, there is a non-zero risk that it could have bugs. Bitcoin does have a strong culture of security among its developers, and code changes happen very, very slowly and consciously, but something could happen. The promise of quantum computing could allow somebody with quantum supremacy to steal Bitcoin from any Bitcoin wallet. However, this requires extremely sophisticated hardware, not available to any home hacker. And quantum supremacy also has the power to crack any password in the world, not just Bitcoin. So it's like a nuclear weapon. Once it is known that an adversary has it, defenses can be created by altering the code. Also, if a government develops quantum supremacy, they're more likely to use it on an opposing country rather than the Bitcoin network. And there are much larger ramifications for quantum computing than just hacking the Bitcoin network. So this is generally considered a very low and long tail risk, similar to developing cold fusion as a risk to energy companies. Possible, but it'll be a while and people will see it coming. Another risk, exchange hacks. So there's an old adage of not your keys, not your coin. Anytime you hold your crypto on an exchange, you are trusting the exchange to protect your assets. Similar to trusting a bank to protecting your cash from bank robbers. This is known as custodial risk, and each exchange has different methods to mitigate and manage this risk. Of course, you can avoid this risk entirely by taking self-custody of your own Bitcoin or on a USB hardware wallet or a protected passphrase. 51% attack. So Bitcoin could be hacked if somebody acquired 51% of all the network's computing power to act maliciously. Game theory incentivizes all current participants to secure the network because the act of hacking Bitcoin to steal it would disintegrate the price of Bitcoin. So it's pointless to spend billions of dollars in money and energy to steal a worthless asset. However, say a country wanted to waste money and direct all their resources just to destroy the Bitcoin network. They would have to acquire 51% of all the mining hardware, which takes time due to production and supply constraints, during which time the network can observe concentration happening and react accordingly by preventing hardware sales to that bad actor or redistributing the hardware. So say in a scenario, the US adopts Bitcoin and China wants to destroy Bitcoin in order to cripple the US. The US could also defend the network by simply launching a physical drone strike on China's miners. Another risk, altcoin inflation. Satoshi Nakamoto created digital scarcity, but the irony is that because Bitcoin's code is open source, it could be copied. And so now we have multiple different copies of Bitcoin, all doing slightly different things. So the argument is that Bitcoin isn't truly scarce because of all these other blockchains. While it is true the code can be copied, the network effects cannot. So we have other cryptos like Bitcoin Cash, Bitcoin SV, Litecoin, dog money, etc., that mimics Bitcoin's functionality, but they don't have the same network effects as Bitcoin. There are only two blockchains that have serious network effects, and that is Bitcoin and Ethereum, and they serve two different markets. Any questions regarding risk?
Yes. So I think earlier someone was asking about how hardware ledger wallets work. So because you mentioned not your keys, not your coins.
Right. So the way Bitcoin works is using something like PGP technology called pretty good privacy, where there's a private key and a public key. The private key is basically what allows you to access a spot on the blockchain, kind of like your own little cubbyhole that stores your Bitcoin. Now, this key can be generated from a series of 24 words or seed phrases. So you can basically store that phrase in your head or use a hardware wallet like Ledger or Trezor or KeepKey. There are a bunch out there that will basically encrypt that phrase so that all you need is like a PIN number in order to access it. So once you store your key there, then you can plug that USB stick into your computer in order to access your Bitcoin wallet. And then you could secure that key by putting in a safe, all different kinds of other methods of physical security.
So about those ledger wallets, you want to make sure that you don't buy off eBay or second-handed places. You want to buy directly from Trezor and Ledger. Okay, that's very important. And as far as storing the keys, one question I get asked is, does the sequence of the words matter? Right?
Yes, they do.
Okay, great. All right, Hannah asks, do you know how much global money has been invested into purchasing Bitcoin? And what happens to the cash that the cryptocurrencies collect from the tendering?
Yeah, so Bitcoin has about a $1 trillion market cap. So I think currently it's about $850 billion have gone in to purchase Bitcoin. So miners on the Bitcoin network are the only people that create new Bitcoin. So if you wanted to buy a new Bitcoin that nobody holds, you would have to buy it from a miner. So the dollars that new money that goes in would go to those miners, and those miners take that cash and pay for the energy and hardware costs that it took to mine the Bitcoin. Of course, you can buy Bitcoin already in circulation from somebody else, and that is simply set by market demand forces.
Nice. And I also thought of something about on-chain, like through exchanges, and off-chain, like through Trezor. Realize that don't put all your eggs in one basket, right? So let's say Coinbase. Coinbase is the one that most people know. The onboarding retail goes in. They usually have a lot higher fees than some of the other ones that we're going to be talking about, like Gemini. And so realize that there's no FDIC protection yet. However, you can earn interest and yields on different exchanges. And those yields, I believe Haz will talk about in just a bit. But regarding protection, realize that it's kind of like a flash drive, these Trezors. So you plug it in, and then you keep your seed key safe. You can even memorize them. And so there's different ways to protect yourself.
Right.
Okay.
Some people I know split up their seed phrase between several different locations, maybe several different people that they trust. So that way nobody has all the entire seed phrase.
Yes. All right. CK asks, why aren't sovereign funds jumping in to mine, to buy? What are they waiting for? Great question, CK.
I think they are starting to. We are just starting to see that happen.
So just to share real quick, Michael Saylor with his company started acquiring Bitcoin and has mentioned this already. I want to point to this. There was a conference call where he just opened up his books, right? So he spent millions and millions of dollars through lawyers and through setting up his company on how to account for Bitcoin, how to put it as a part of his public company. And so I was on that call, and there was a lot of public companies that were participating, and it takes time, right? It's like when you first hear about it, oh, what is that thing? What is that thing? And that's why key things like El Salvador being the first country to adopt it, right? That's a big step forward. Like Tesla, right? Putting it on their balance sheet, big step forward. So adoption, as more and more people adopt it, then it gains more people know about it. More countries will be like, oh, we should do that. And
at some point, it becomes too large of an asset class to ignore.
Yep. Ellen asks, in the best case scenario for ETH, people compare it to gas. Curious if you think it will follow the same trend as BTC.
So Ethereum and Bitcoin have two very different intentions in mind. Bitcoin is what's known as a non-Turing complete language, which means in its code, it does not have if then else statements. You cannot build smart contracts or logic within Bitcoin. And that's by design to reduce the number of attack vectors. Ethereum is a Turing complete language, meaning that you can build applications, software, everything on Ethereum, which does make it more prone to attack vectors, but also gives it much more functionality. So Ethereum and its potentially end game case, all the world's software runs on Ethereum. That would be the example. And in the end case for Bitcoin, all the world's money runs on the Bitcoin rails.
Yes, and I wanted to add that what we're seeing here this time in history is a rise of a new asset class, right? And Ethereum, as has mentioned, as the world's supercomputer, right? Putting smart contracts. That's why you hear all these things about NFTs. And to give an example of a smart contract is you can write in there, like when these conditions are met, it doesn't matter what, it will execute this, right? And so that allows like this, that's why the Ethereum network effect and gas is so high right now, is because all these development that's going into Ethereum.
So Ethereum basically eliminates the need for escrows or any trusted third party or a third party that needs to be there to mediate something between two other parties, because you can basically have computer code handle it.
Yep. So the upside and opportunity with Ethereum is definitely there. Is Bitcoin's value mostly due to the blockchain technology underlying it? Question.
Absolutely, yeah. I mean, fundamentally, as I said near the very beginning of this presentation, Bitcoin solves the double spend problem. So Bitcoin created the ability to have digital scarcity, which never existed before. And that's only due to the blockchain technology. Without digital scarcity, you could simply copy Bitcoin, have lots of Bitcoin, rendering it worthless.
Yeah, and that's why 21 million Bitcoins will ever be in existence, maximum. So with Ethereum, they recently made a change, a shift to update the protocol so that it's more deflationary, but that's a different topic. Okay, CK asks, what two different markets are they? I believe has answered that. Henna asks, I thought Bitcoin ownership was supposed to be anonymous. Aren't the crypto exchanges obligated to report gains and losses to the IRS? So is there still a way to remain anonymous?
Yes. So a more accurate term would be pseudonymous. So every address on the Bitcoin network is a string of numbers and letters, which is a pseudonym for you. Now, all exchanges are becoming regulated to have KYC AML, which means know your customer, anti-money laundering laws, which is beneficial for the industry as a whole because it keeps it much cleaner. But if you were to purchase Bitcoin off an exchange, earn Bitcoin, there are many ways to acquire Bitcoin without having to give your personal information and having your identity tied to a wallet.
Great questions, everyone. Keep them coming. Go ahead, Has.
So as you've probably heard, there are thousands of cryptocurrencies. But if you look at the history of the top 2,000 plus crypto coins, nothing has outperformed Bitcoin over the long haul. If you think of Bitcoin like land, it has ultimate scarcity and remains relatively unchanged over time. You can think of blockchain ecosystems like Ethereum as buildings on the land, and the building may have upgrades and are likely to change over time, such as Ethereum's recent switch from proof of work to proof of stake, or splitting off from the original Ethereum, which is now known as Ethereum Classic. Then you have the businesses that run inside the building that sits on the land. And these businesses are like some of these NFT platforms, ICOs, or specialized blockchain applications that run on the Ethereum blockchain. All businesses are centralized, have a single point of failure, and are constantly competing with each other. Very few businesses last more than a few generations, although they could have rapid growth in value during the existence. Over 90% of ICOs, or initial coin offerings, from 2017 have gone to zero. As Bitcoin offered the best Sharpe ratio against other asset classes, Bitcoin also offers the best Sharpe ratio, which is risk-adjusted returns, against other cryptocurrencies. Now, while Bitcoin is looking to solve the problem of sound money, and other altcoins look to apply blockchain technology for other specific applications, I felt the need to address Dogecoin, which is a meme coin created in 2013 as a joke by two engineers that are no longer involved with the project. Dogecoin is an inflationary coin, which means it has no supply cap and will have an infinite number of coin created. Currently, there are 128 billion Dogecoin in existence, and 5 billion will be added every year, which translates roughly to a 4% annual inflation rate. Dogecoin has also had almost zero development on its code since inception, and only recently picked up a few developers after the recent hype because they had to readjust the code because the transaction fees started to actually become meaningful, more than it was ever intended due to the pop in price. Dogecoin is also highly centralized in terms of wealth distribution. The top 10 address holders, top 10 addresses in Dogecoin own about 47% of all the coins. Whereas in Bitcoin, the top 10 addresses own about 5% of all the coins. So I'll let you draw your own conclusions on Dogecoin from there. So hopefully you've learned something about money, something about Bitcoin, and have some perspective on where altcoins lie relative to Bitcoin. I'll wrap up here, and hopefully you feel armed with enough knowledge to make an educated decision, or at least learn more so that you don't feel like you're spinning a roulette wheel. Here are some additional resources I've vetted and filtered to help you distinguish signal from noise. Any questions?
Juan has a question. What happens when all 21 million BTC have been mined?
So once all 21 million BTC have been mined, which will happen in about 120 years, then it is likely, if hyper-Bitcoinization happened, that Bitcoin becomes the global reserve currency, and it becomes what's known as the end game. So the network, all the miners, instead of mining new Bitcoin, they will validate transactions and earn a transaction fee for all the Bitcoins that are transacted on the network.
Any other questions? Feel free to just put it into the chat. What about this saying has that price doesn't equal value, right? Because sometimes people are looking at like something like, oh, Bitcoin, it's a 46,000 for one coin. I want to feel like I have more, so I'm going to go buy 100,000 of this penny stock or this penny valuation. And if it goes up 3x, then I have 3 times my money.
Yeah, so, I don't like to buy things just because they're cheap. I like to buy things because they have value. And, a lot of people will buy things, because they see Bitcoin, one Bitcoin is 40,000, 50,000, and they may not realize you don't have to buy a full Bitcoin. You can buy what's known as several Satoshis, which are, Bitcoin is divisible to 16 decimal places, so you can buy fractions of a Bitcoin. And for me, I would much rather buy something that has value, and if a 5x gain is still a 5x gain and would likely outperform any other asset with taking into account risk.
Yeah, I think a good example for people is like, if you invest $10,000 when Bitcoin is 50,000 and it goes up to 100,000, your $10,000 2x'd, right? So sometimes people have this correlation of like, oh, Bitcoin's so expensive, or I'll wait till it's cheaper. I'll wait till the next drop, right? And just realize that there is, you invest 10,000 in what it is today, and it goes up 2 times, then that's 2 times the value.
Right. And I would also say, remember to invest for the long term. So as I discussed in one of my earlier slides, Bitcoin has a 4-year cycle, and anybody that purchased Bitcoin in any time in its history and held for 4 years has been up over 100%.
Another thing I like to bring up is about asymmetrical upside. It's really important to understand that it doesn't cost $1 to make $1. I know on my personal journey, that's how I thought before. But recognize that the upside of what we're looking at, 10x for disrupting gold and more beyond that. You're looking at, if you invest out of $100, and this is called the 1% theory, if you put $1 into Bitcoin, if you lose it, you lose 1 out of 100. But asymmetrical upside is if you put pennies to make that dollar, or you have much greater return on things that, has a greater return that's not necessarily tied to that risk.
So I think one way to really think of that is portfolio allocation.
Yeah.
So obviously, it's probably not a good idea to put 100% of your net worth into Bitcoin, right? However, if you were to allocate just 2% of your net worth into Bitcoin, then if Bitcoin were to go to zero, you would have a negative 2% impact on your net worth, which while that may not be great, it's not going to materially affect you. It's not going to change your retirement plans. However, if Bitcoin were to disrupt the gold market and continue Metcalfe's law, have network effects and so on, and 10x's as predicted by various models, that 2% would go to 20%. And so that is a meaningful impact on your retirement or net worth. So then the downside is negative 2%, and the potential upside is plus 18%. And that's asymmetric risk reward for portfolio allocation.
Very well said. All right, so we're getting some question about price prediction. Where do you personally believe the value of Bitcoin will go over the next 10 years, 20 years, 50 years relative to today's dollar? Price per Bitcoin, not total value.
Right. Let me pull up one of these. Right. So here's stock to flow model, which predicts, within the next few years, we'll hit 100 grand per Bitcoin, and then upwards of $1 million per Bitcoin. And I think at some point, this model breaks down, and that's because we're comparing it to the US dollar. And if we keep printing money as we are, the US dollar becomes worthless. So at some point, it really doesn't matter if you've got $1 million US, $2 million US. It's like having, 5 million Zimbabwe dollars. The actual currency you're comparing it to loses value. What I think will happen over the next 10 years, 20 years, is that assets will actually start getting priced in Bitcoin. Because of its immutable and fixed supply, it creates a steady unit of account that does not get inflated away. So once goods and services start getting priced in Bitcoin, then you'll have its own price discovery in Bitcoin, and the price in US dollars won't matter as much.
I'll put a price prediction out there. I personally feel that a Bitcoin will one day be over $1 million. It's a fixed supply that can't ever be produced more. And as more countries adopt it, there's only a limited amount. Now, having said that, there's also volatility. There's also adoption, the time. So that's my personal belief of where it's going. Any other questions? Let's see.
I have a question.
Mm-hmm.
So yes, was it Friday that you made a metaphor of land and building and businesses, applications, and so forth. I get that both of you are long on Bitcoin, right? So the land is going to be rich and with lots of buildings. So yes, maybe you didn't really talk about dollar cost averaging. Maybe you could talk about that, or I'm also curious about your perspective around perhaps specific building or specific businesses, or how you evaluate the value in these things, so that way we can also keep our eyes beyond just the land itself.
Sure. So there are a couple of tried and true investment methods in the equities market, such as your 401k, IRAs, that have been proven out over decades. And the best way to invest in your 401k is via a method called dollar cost averaging, which means out of every paycheck, you put a little bit of money into your 401k. This ensures that you never buy the top of any market cycle, You also won't ever buy the bottom, you'll buy the average price. And so you can apply this principle also to Bitcoin and crypto, where you dollar cost average into the market. If you've got 10 grand to allocate, you could put in 1 grand a month every month over 10 months, and then you'll be sure to have never, not be buying at the very top. Although, as I've shown with Bitcoin anyway, even if you bought at the very top over a 4-year period, you'd still be up over 100%. But dollar cost averaging is an excellent way to take to minimize risk. The other tried and true method in traditional equities is buying the index. So some of you might know Jack Bogle, founder of Vanguard, and he put a challenge out to any fund managers that could beat the S&P 500 index over a long period of time. And pretty much nobody could do it after fees were taken into account. So I personally don't try to pick the unicorns in the crypto market. I'm long on Bitcoin, and then I hedge against that with a top 20 crypto index, and I just dollar cost average into that index. I'm sure there's some people who are excellent, better stock pickers than I am though.
I do want to echo what Has said about dollar cost averaging. That's something that I personally recommend to my family, right? It's just something that you're just investing in it for the long term. And this is something I always share with people who are getting into the space, because you can get some pretty great returns in this crypto market. But there's a lot of volatility, right? So I ask people, are you trading or are you investing? Right? And there's a difference, right? When you go to Vegas and you're going to the blackjack table, are you there to make money or are you gambling, right? It's just to understand that the perspective of some of these, especially some of these, let's say Ethereum or altcoins, the volatility is very great. So as Has mentioned at the beginning of this, asset allocation is key, right? I teach people to become enlightened millionaires and the abundance mindset. Now, when your asset class crashes by 50% overnight, how do you deal with that emotionally, right? So it's something that choosing your abundance mindset is really important over scarcity mindset, because it's easy to say, oh, I feel like FOMO. I'm missing out. And then oh, it crashes. Then you sell it when it's down. Then it's you want to buy low, sell high, right? All right. Ellen asks, same question for ETH. The value of ETH. You want to start first, Has? You want me to go?
Well, the challenging thing with ETH is they've changed the consensus mechanisms and governance multiple times. So it's much harder to predict. We don't have the same kind of modeling, consistent modeling like we do with Bitcoin. ETH used to be and is currently proof of work. It's switching to proof of stake. The issuance of how many ETH are available or generated change. So it's much more difficult to predict using a stock to flow model. There are some models that utilizes the network effects of Metcalfe's law and calculates if ETH continues on its trajectory, it would be upwards of 20 grand per Ethereum in the long term.
Yeah, and regarding ETH, I mean, there's different beliefs out there, right? And so some people say they only believe in Bitcoin, right? They're called a Bitcoin maximus. And then there's others who believe that, Bitcoin is the tide that raises all boats, right? It's going to bring all these new opportunities, right? And so just as has mentioned about those numbers, I personally believe that ETH has the network effect of how much momentum it's built. It's pretty strong right now. If you guys hear about Solana and how it's building momentum, is because like the gas prices are so high, right? The network is congested. So that's something to consider.
One of the things I've thought about Ethereum is that if it is to become the software layer of the world and all the world software applications are built on it, it would actually be disadvantageous for Ethereum to be expensive. So all utilities need to be cheap to have global access. So the more something is used, like cable internet, you can't have internet being very expensive to have massive adoption. And the price of internet has come down over time. The price of computers have come down over time. So I'm not sure how the model works for Ethereum, continually raising in price if all the software is built on it.
Yeah, there are definitely a lot of changes going on with Ethereum. And like we said, one of the ones is that they're starting to burn the Ethereum to make it deflationary, so that because they don't have that fixed 21 million like Bitcoin. And so they're looking to what ways to adopt that into their changes, if you will. Awesome. Stefan.
Yeah. The interesting thing about burning Ethereum also is I try to think about that, push it out to infinity, and you cannot just keep burning Ethereum ad infinitum. Otherwise, you would eventually have zero Ethereum.
Yeah, that makes sense. So Stefan is asking, where can we get a copy of this presentation?
I'll be happy to send it to you personally.
And CK asks, index of top 20 what to hedge Bitcoin?
Yeah, top 20 crypto. So I use, it's called Crypto 20, and the token is C20. But if you go to Crypto 20, the number 20.com, you can find out more information on it there. It's actually a smart contract token that automatically rebalances portfolio allocation for the top 20 crypto on a weekly basis.
Nice. Oh, and I believe a question earlier was like how to get started, and has put it in the screen here. Gemini is started by the Winklevoss twins. And from my experience, my own personal experience of different exchanges throughout the years, they have been the most consistent, right? Sometimes like Coinbase, you'll hear like in the past, the network gets too congested, it'll freeze, or they'll have certain things, but that's the main one that most people know to get started. But there are a lot of different options, Gemini, BlockFi, other opportunities also to earn yield. So to earn interest, right? If you take $100,000 and you put it into Gemini under GUSD, right, as a stable coin, you can earn up to 7-8% on your money. Right. Of course, there's no FDIC like what you would put at Chase Bank, but the interest rates are there's substantial difference. And they're coming out with more adoption things like the credit cards, where you can earn like 3% back in Bitcoin for every dollar that you spend. So, So pretty exciting times here. Awesome. Well, I think if there are no more questions, I just like to express gratitude for each and every one of you for being here and And we're honored, me and Haz, to be able to hopefully add value on your Bitcoin crypto journey. And a special thanks to Haz for putting this all together and sharing.
Thank you,
his
JFlow,
wisdom.
for hosting. I much appreciate it, helping me field questions. Happy to answer any further questions in depth. Outside of this, feel free to message me anytime. I wish you all a beautiful week ahead and much blessings and joy in your life. Take care.
And I'm
Good night,
happy.
everybody.
Good night, everyone. Happy to field any other questions as well. You can find me on Twitter at JFlowLive. Have a great one, everyone. Flow on. This is the greatest flow. It's everything you ever want. Da, 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 da.